Testing, testing. Good morning, Sally. We're about 27 minutes away from starting. Just didn't want you to think we were inattentive here. Okay, I've started to record and remind folks that this program will be recorded and archived on the I-29 Moo University website. Uh, Give us a few days and we'll have that up and ready to go. Okay, I'd like to welcome everyone to the Beef on Dairy Dialogue webinar series. It's an extension of the annual Dairy Beef Short Course held in conjunction with the Central Plains Dairy Expo each March. The short course is the longest running program focusing on steers with dairy genetics in the U.S. with 15 years of continuous programming. This short course is sponsored by the I-29 Moo University. It's a consortium of extension specialists from Iowa State University, University of Minnesota, University of Nebraska at Lincoln, and South Dakota State University. The Beef on Dairy Dialogue webinar series continues today with Dr. Peel covering the current cattle supply and demand fundamentals and expectations for prices, production, and cattle inventory for 2025 and beyond. Dr. Peel is the Charles Breedlove Professor of Agribusiness in the Department of Agricultural Economics. He has served as the Extension Livestock Marketing Specialist since he came to Oklahoma State University in 1989. He has BS and MS degrees from Montana State University and a PhD from the University of Illinois. He previously served as a superintendent of the Southeastern Colorado Range Research Station in Springfield, Colorado. His main program areas at Oklahoma State University include livestock market outlook and marketing, risk management, education for livestock producers. Derrell also works in the area of international livestock and meat trade with particular focus on Mexico and Canada and the North American livestock and meat industry. He lived in Mexico on sabbatical in 2001 and has developed an extensive knowledge of the Mexican cattle and beef industry and the economics of cattle and beef trade between the U.S. and Mexico. As I always say, Dr. Peel, the podium is yours.
All righty. Well, thank you, Fred, and good afternoon, everyone. It's a pleasure to have a chance to visit with you a little bit in this interesting world that we have now. The collision of beef and dairy markets in a way that we would not have even dreamed of just a few short years ago. And so now lots of things are happening on both sides of this of these two markets, I think. So I'm going to talk about the cattle market, mostly from a beef perspective, but obviously now there's a lot of direct interaction, more than we've ever seen in these markets. And so and we'll talk about that. I actually have a couple of graduate students that are working specifically on this area of the beef and dairy sector interface that's working. And so we're all learning a lot of things and so on as we go forward. So let's see here. There we go. So just quickly to summarize where beef cattle markets have been, some of my data will be more Southern Plains oriented compared to the Midwest, where many of you are. But the overall price levels will be they may be slightly different. The patterns will certainly be the same. So, calf prices in the Southern Plains have continued to advance. We'll look at these in a longer historical context in just a minute. But just to bring you up to speed on what's happened so far this year, we've seen a significant increase in these prices for calves, for the bigger feeder cattle, even a little more sharply there. And then if we look at the fed cattle markets, same story again across the board. We've seen higher cattle prices. That really goes back to late 2022 when this market really took off, and we've had a relatively steady increase through most of the time period since then. So, excuse me. If you look at these markets, the blue line on top is a calf price, the green line is a fed cattle price, or feeder cattle price, excuse me, and the red line is a fed cattle price. And so you can see about 15 years of average prices here and the relationship between these markets. There's a couple things that are important. Obviously, on the far right-hand side, you can see the run-up that we just talked about that we're at. And obviously, the question on everybody's mind is, are we approaching the top here? Are we at the top? And how long will these price levels at? We're obviously at historic price levels that again nobody really could have anticipated not too long ago. And what's on a lot of especially beef cattle producers is looking at this chart is about a decade ago we had a similar run up in prices, which at the time set new record levels. And the conditions that created that situation were somewhat similar to what we have today. It was largely drought driven liquidation that caused those prices in 2014 and 2015, and they didn't last too long. They lasted about 2 years, and then the markets came back down pretty dramatically. And that's what's on people's mind, I think, now is worried about kind of a spike top here that we put a top in, that it doesn't last long. And we'll talk about that as we go forward. I will say that to kind of preference where we're going from here, that the conditions, as I said, were somewhat similar about a decade ago, but there's also some very important differences now that I think makes our expectations for the next few years quite a bit different. The other thing I would point out while we're looking at this chart is the fact that these lines, if you'll notice, to be very non-technical about it, these lines get farther apart when prices go up. In other words, the spread between calf and feeder prices gets wider. The spread between feeder cattle and fed cattle gets wider. And that actually goes all the way through the system up through the meat levels as well. And it really emphasizes 2 points. One is that this market is very focused on these calf prices right now because we're trying to incentivize some herd rebuilding. We are at very low levels that we'll look at here in just a second. But, everybody above the cow-calf sector in this industry is a margin operator. If you're a stocker or background producer, you're buying calves and putting weight on those to sell as feeder cattle. So you can see that this spread that's shown on this chart means that buy-sell margin actually gets trickier as prices go up. The price of calves is going up farther and faster than feeder cattle. Price of feeder cattle is going up farther and faster than fed cattle. So all these margin operations above the cow-calf level, not everybody's enjoying these high prices, I guess is a nice way to say it. There's some challenging margins in there, and we'll talk about that as we go forward. Just to round out kind of a survey of basic cattle markets here, this is a cull cow price series from Oklahoma. You can see it goes back, shows the last 5 years or so, and we've just continued to see these cull cow prices. So, again, at pretty unimaginable levels just a short time ago, these cull cow prices. And actually, we've seen more decrease on the cow side than anything else. We'll look at slaughter numbers in just a minute. The underlying story for the current cattle market situation is just a basic one of numbers. The beef cattle industry is inherently cyclical, but what has happened really since the last peak in 2018 or 2019, these are the recent year cattle numbers that we got from USDA. And you can see there's a couple of gaps in it because we've had a few years where they did not put out this report. So we don't have last year to compare, but you can see in general, we've been liquidating since 2018, 2019, depending on whether you look at January, July. And we started down, but then it was drought that pulled those numbers down much faster. So we're at the lowest level in this July report. The data goes back to 1973. We're at the lowest beef cow inventory in that. And in fact, if we look at the January numbers, which goes back farther, that report has a bigger history. We're at the lowest beef cow herd we were coming into 2025. We were at the lowest level since 1961. And so, that's the question. We find ourselves at this low level. And obviously, with the prices telling us that we're probably lower than we need to be, when will we begin to rebuild? On the beef heifer side, again, we've got to save heifers. We're going to rebuild. That number was also at the lowest level in the history of this report for the July 1 inventory. So if you look at those as a percentage, the heifers as a percent of the beef cow herd, you can see three, high levels in here. In the early 1990s, that was a cattle herd expansion. And obviously to do that, you have to save heifers. So that percentage goes up. The mid 2000s was kind of a mini cycle, but it was technically a cattle cycle. And then that 2014 to 2018 or 19 period, we had that increase. So what you see now, of course, is that we don't see any increase in that beef replacement heifer percentage. And all of that to say that we don't have any real indication yet that on the beef cattle side that we are in fact saving heifers and beginning that process of herd rebuilding. I also put in a chart here on the dairy herd replacements. The dairy industry, of course, is not as cyclical as the beef industry. So in terms of the overall cattle market drivers, it tends to be the beef herd dynamics. But the dairy side is very interesting with all of the changes that have happened in the last few years with the reproductive technology, the sex semen that we're able to use. The dairy replacement heifers is actually at the smallest level in the history of that July report as well. And if you heard the comments Fred and I were talking about earlier, there are certainly some indications that the dairy industry faces some challenges internally just to sort of maintain their herd levels and their herd productivity, given the levels of dairy breeding production at this point in time. Out of that July inventory report, as well as the January report, we calculate from several inventory categories, we calculate an estimated feeder supply. And, the bottom line here is the same story. The 2025 July 1 estimated feeder supply was the smallest as far back as we can calculate it. So feeder supplies have been getting tighter. The calf crop in the U.S., both combining the beef and dairy into the calf crop measure that we get, has been declining since 2018. So we've continued to tighten up feeder cattle supplies. And that, of course, is the underlying driver of all of this. Again, drought was a big factor from really late 2020, but 2021 through 2020, early 2025. Drought was a significant factor in driving that liquidation and those decreased cattle inventories. At the current time, this is this morning's drought monitor. For the most part, we are in the best shape that we've been in, taken collectively as a country, with very little drought, except in the far western part of the U.S. There are some significant drought areas, but it doesn't represent large concentrations of cattle from a beef perspective. So really, drought is not a limiting factor in what the industry can do right now. It has been up until early 2025. Drought was still a continuing limitation on the beef industry, but not so much now. So it's other things that will determine, when we get started with some herd rebuilding and how fast that will proceed. One of the good things is that we are in somewhat better shape generally from a forage standpoint. So I put a graph on here of the latest USDA estimates for 2025 hay supply. We carried in larger May 1 hay stocks for the beginning of the hay crop year, and the estimated production was also up slightly this year. And so all in all, we're in relatively good shape. Hay markets are very regional, so it depends a little on where you're at, but in general, we're pretty good. From a feed standpoint, we've got a record corn crop coming on. I don't have to tell most of you that, given where you live. And if you're a crop farmer, it's not necessarily such good news. But from a feed standpoint, very attractive feed prices. We expect those to persist as we go forward. I have some data from Kansas feedlots that shows how the feedlot cost of gain has come down from a peak in 2023, declined really through the end of 2023, all of 2024 to the current levels. And so we've seen the most favorable feedlot cost of gain numbers that we've had in a while. That's a positive factor for feedlots, um, certainly compared to where they were on that standpoint. They do have some other challenges as well. One of which is that margin that we talked about earlier. So shows the current difference between feeder cattle prices and fed cattle prices. And you can see that spread is as wide as it ever gets or ever has gotten in the past. And so that buy sell margin, now this is at one point in time. So this basically tells you the gap between what feedlots face when they sell a pen of cattle and replace them with new feeder cattle. They face a very wide gap between that buy sell margin. And that's a challenge. Now, the market's been going up pretty steady over the last 2 years. So the time lag between when you buy those feeder cattle and when you sell the fed cattle has made up for part of that adverse buy sell margin. Up to this point, it may not continue to do that. We may not see these prices advance quite as fast going forward. And the other problem that feedlots face is just there's not enough cattle. And so the supply of feeder cattle, as well as the record price levels we have for feeder cattle, will be an issue for feedlots as we go forward. Cattle on feed numbers were kind of slow to come down, given that the calf crop's been declining for about 7 years now, but it is starting to come down. You can see the monthly numbers here. Of course, we're at a summer low. That's seasonal. But we've been running now 8 consecutive months. We've had year-over-year decreases in cattle on feed numbers. And when you put it in a longer term context, you can see the blue line is the actual monthly cattle on feed numbers. They're very seasonal. The green line is an average, a 12-month moving average. And the August 1 cattle on feed number was actually the lowest one we've seen since sometime in 2017. And the 12-month moving average now has dropped to the lowest level we've seen since sometime in 2019. So these tight feeder cattle supplies are really catching up, if you will. Feedlots have kind of avoided declining as much through some things we'll talk about here. But going forward, I do expect to see these feedlot inventories continue to tighten up. And this is all happening without, in fact, saving heifers. So feedlot placements and marketings have been coming down. But because of the way feedlots have managed things, they have not shown the decrease in the overall inventory of feedlots. And part of that is because we've continued to feed heifers. So if you look at the heifers as a percent of the total feedlot inventory, it's been up here above average levels for several years now. At some point in time, we will need to retain heifers in order to rebuild the herd. And when we do, then this percentage will drop down. And of course, that'll pull those heifers out of the feeder supply and keep them for breeding, and that will tighten up an already tight feeder cattle supply even more as we go forward. The other thing that feedlots have done for the last 2 or 3 years is they've really slowed down the rate of turnover in feedlots, and so they have an incentive to do that. Obviously, they're trying to keep their feedlots as full as possible. And so they've slowed down the turnover rate, even though they were actually placing less cattle on average. And so the days on feed continued to increase. Now it's starting to come back down on the far right side. You can see that average days on feed, again, this is Kansas feedlot data, but I think it's pretty indicative of the broader cattle feeding industry. Those days on feed had probably maxed out and they're coming back down. So all of those things together suggest that we will see more consistent and probably a little more pronounced decrease in these feedlot inventories as we go forward in the next few months to perhaps a couple of years. When you feed cattle longer, those days on feed add extra carcass weight. And we saw a huge jump in carcass weights in 2024 for the whole year, pretty much. We're still above those levels even in 2025. You can see here, although the gap is narrowing, we're not up nearly as much as we were last year. In 2024, slaughter didn't drop as much as we expected, but it did decrease somewhat. But the increase in carcass weights more than offset that. So we didn't see any decrease in beef production in 2024 that we earlier expected. 2025, we are seeing some decrease now. I think that's coming up here. Let's go. Oh, I've got ahead of myself. This is the slaughter number so far this year. Let's finish talking about that, and then we'll put the carcass weights with it. And so, cattle slaughter is down about 5.4% so far this year. That is both steers and heifers. And that's really the big change. You can see in here last year, in this second to the right-hand column, steer and heifer slaughter actually didn't decrease last year. It is down about 4% so far this year. Cow slaughter has been declining all through 2024 as well as 2025. And so, we were down 15% on total cow slaughter, both beef and dairy down. Dairy's not down as much this year. It is still down. Beef continues to be down. And so the cow slaughter has dropped even more dramatically. But the fed cattle is the part that's really changing. You can see that here. So if you put steer and heifer slaughter together as fed slaughter, it really started to change in about the second quarter. On a weekly basis, you can start to see a bigger gap here, bigger decrease in that fed slaughter. And that's the biggest thing that's changed so far this year. Cow slaughter was already down. Now the fed slaughter is down. And so going forward, we're seeing more decreases now in beef production. Again, it really started at the beginning of the second quarter and continues and looks like it will continue going forward. So, last year we had no change in beef production. This year, this says 2.1%. I think there's even a chance that we'll be down a little bit more than that as we go through the year. It looks like we're going to continue to tighten up that slaughter, and that increase in carcass weights is less on a year-over-year basis, even though they are still higher. So we may see an even bigger decrease, 2.5% perhaps a decrease in beef production. Pork and poultry are in ample supply. And that's really all I'm going to say about that. We'll talk about demand here. Right here, you can see that, box beef values, wholesale beef values have continued to be extremely strong. We've not seen any sort of pushback, if you will, to higher beef prices. We do have record retail prices for beef. Pork and poultry just don't seem to have had much impact or are not having any impact to speak of on beef demand at this point. One of the things I mentioned that cow slaughter has dropped the most. And so among the most pronounced, almost all beef cuts are higher, virtually all of them. But among the most pronounced of that is the ground beef market is at record levels because of the decrease in those non-fed beef supplies, if you will. We use cull cows and bulls for the lean to go into ground beef, and those prices are at record levels as we go forward. So all of that adds up to record level retail beef prices. And again, we've just not seen, we've been watching it for really ever since the pandemic for signs of any sort of decrease or weakness in beef demand, and we just have not seen it. And again, it's not for lack of alternatives in the marketplace. Consumers just seem to be very, resilient in their beef demand at this point. Just a couple slides on trade. I'm not going to say too much about it. Obviously, there's a lot of turmoil in terms of the politics and the broader macro environment in both the U.S. and around the world. We have seen decreases in beef exports from the record level we had in 2022. We expected some of that at least going forward with tighter supplies and high prices. And of course, now again, we've added a lot of tariff issues and other things, uncertainty in the market that have added to that. So we are seeing some decreases in that. The biggest one, of course, you can see here, this lists our major beef export markets, but the biggest decrease, of course, has been in China, where we've had the huge tariff impacts in terms of those markets that we export beef to. So that's been the biggest impact there. And there's, those things are still evolving as we go forward. It's definitely a very dynamic situation. On the import side, we do import beef. We have for a long, long time. Much of what we import is, in fact, lean beef that supplements our domestically produced, called cow and bull beef, that we use for ground beef. In this situation, since we have seen sharp decreases in the non-fed beef production, we've had very large jumps in imported beef. It went up some in 2024, has jumped sharply through 2025. Of course, these are first half of the year numbers that we have available. And so you can see big increases in Australia and Brazil in particular. Now, of course, we've got new tariff issues with Brazil that will change this in the second half of the year. And so we'll have to monitor that as we go forward in terms of the impact of those lean beef supplies in the U.S. and the implications that might have for the ground beef market. Excuse me. I need to mention this. You've no doubt heard about the screwworm issues. It's a big deal down here in my part of the world directly, but it certainly impacts the market broadly. This is kind of the history of imports of cattle from Mexico going back a long ways. We average about 1.1 to 1.2 million head of cattle from Mexico on average. It does vary somewhat from year to year. And that sounds like a big number when you say it in absolute terms. The imports of cattle from Mexico is about 3.2, 3.3% of our U.S. calf crop. So it's not the major part of our supply, but it certainly is a component of our total cattle supply, feeder cattle supply in the U.S. And of course, that market's been closed most of the time since last November when the screwworm was first detected in Mexico. It was open briefly for a while between February and early May, and then now it's closed again, and I would expect that it will likely stay closed for the foreseeable future. I do not anticipate this opening back up this year, and perhaps not for multiple years as we go forward. Lots of issues, of course, lots of concerns about the potential for the screwworm fly to reach the U.S. Hasn't happened yet, but it is a distinct threat that's out there. So we're pulling an additional, for 2025, the impact of this closure of the border for most of the year is probably reducing that tight feeder cattle supply that we already had by another, I'm going to guess, around 800,000 head. So that's one more factor that adds into why we've got such tight supplies and record high prices for feeder cattle and all kinds of cattle, really. So if we go back to the cattle cycle for a minute, the beef industry, of course, has been cyclical for 150 years. And we look at this, I've highlighted in yellow shading here the last three expansion periods, because that's kind of where we're at now. We think we're at a low. We may see just a fractional increase in the beef cow herd over here in 2026, given the amount of decrease in cow culling that we've had. But we're about, in 2025, we were about 1.1 million head smaller than we were even in 2014, which was the beginning of the last set of high prices and that herd rebuild. So we're starting at a smaller level. And the big difference, of course, this time is that we are not equipped to change this very fast. In 2014, we had the capability to save heifers. And heifer retention went way up to record levels. Cow culling dropped to a minimal level. Those are the two things that you have to do to rebuild the herd. So you don't cull as many cows. You can do that for a while. You've got some discretionary culling that you can hold off on when the market suggests that. You save more heifers to rebuild. And so those two things have to happen: increased heifer retention and decreased cow culling. What we have happening over here on the right-hand side at the current time is we do have the decreased cow culling that would be at a level that could suggest herd rebuilding, but the replacement heifer part of this has not started to increase. And this blue line would need to turn up and increase significantly before we could put together much in the way of a sustained herd rebuild. And so that's a big difference, because if you look back over here at 2014, which was the low in the cattle inventory, but the heifers had actually been increasing for a couple of years prior to that. So we started to build a pipeline of replacement heifers that allowed us to expand the herd more rapidly. And that's what allowed for the sort of short peak in prices that happened then. We are not doing that now. We're on a much slower path as we go forward. We have not started, by virtue of the data, any significant heifer retention yet. Anecdotally, I think there is some happening out in the country, but it doesn't look like it's widespread enough to really be a very fast pace at all. And there's just lots of indications. It's the drought, it's financial recovery, financial cost. Obviously, we're in a very different world now compared to a decade ago in terms of the cost of investing in heifers and cows and so on. There's lots of factors that play into why we're on a much slower path this time. All of that means that we're likely to see, first of all, we're likely to see prices go even higher as we go forward because we have not started to replace heifer or to retain heifers. The last peak in prices, again, a decade ago, happened about a year to a year and a half after we started heifer retention. So we're probably moving higher yet on prices, and it looks like we're going to stay at an elevated price level for an extended period of time. So cow-calf producers are in the driver's seat here. They're seeing record level returns. Again, the market's trying to focus on them and provide the incentives for that herd rebuilding. So far, the response has been very slow at this point, but so it looks like those returns will continue to be good. And I mentioned earlier that the returns, the margins for everybody above that level were tricky. It's particularly tricky for backgrounding cattle. So feedlots have done okay. Cow-calf producers are doing pretty good. The stocker or backgrounding guys in the middle really face a challenge. And there's a lot of numbers here, but let me highlight a couple things. In today's market, you could sell a 500-pound steer in Oklahoma last week for about $4.60 a pound. But if you take that 500-pound steer over here and start adding weight to it in today's market, if you put 250 pounds on it, so go to 750 pounds, those additional 250 pounds are worth less than $2 a pound. So that's that buy-sell margin that gets a little bit out of whack. And with the combination of tight supplies, cheap cost to gain in the feedlot, and high calf prices, the role for backgrounding cattle is not there. The market's basically just telling us produce calves and get them into the feedlot as quick as possible. So if that's something that you do, there's just not a lot of incentive here for adding that weight in a traditional kind of a stocker program. So price outlook, after having said all that, and I've sort of alluded to this already, we don't think we're done going higher. We probably won't go up at the same rate going forward, although it depends on whether we get really aggressive with heifer retention. But I do expect prices to grind higher for the rest of 2025 through 2026. And given that we don't have any indication that we're saving heifers yet, we may take the peak in prices even into 2027. I do think we're going to be at generally elevated prices probably at this point for much of the rest of the decade. Maybe by the very end of the decade, if we start to see some growth in the next couple of years, we might see some price pressure by the very end of the decade. But with none of that happening yet, if you think about the timing here, we don't have a very big pipeline of replacement heifers today. So if we start in 2025 by saving heifers, we can save that heifer. We can breed her in 26, calve in 27. It's 2028 into 2029 before we start changing beef production from any herd rebuilding efforts that start right now. So I think we're in for an extended period here in the second half of the decade for generally tight supplies and generally elevated prices as we go forward. So let me summarize this. I guess we've said all this. Herd rebuilding could be just starting, but it's a very slow process. I don't have any data that actually can confirm it in an aggregate sense that they're starting any herd rebuilding. The margins, again, are strong for cow-calf returns, pretty variable for everybody above the cow-calf level. The supply fundamentals are tight, will get tighter before they get better, and it looks like we're going to continue to see tight prices and tight supplies and higher prices for cattle and for beef. Demand has been very robust so far. Now, if something were to happen, and that really gets to that last bullet, there's a lot of volatility in this market. Part of it's just the level we're at. You expect more volatility, but also the uncertainty in the external market. Cattle markets internally, these fundamentals are very, very strong. Cattle market's pretty bulletproof. When you look at the broader external environment of macroeconomics, again, in the US and globally, you look at political volatility, there's lots of potential for external factors to impact this market. Producers still need to do some risk management because of that volatility, even though our expectation in general is for some continued increase in prices and certainly continued support for generally high prices as we go forward. So that's kind of the cattle market situation. I'm going to stop here, Fred. This is how you get a hold of me, by the way. This is my email. I do write a weekly newsletter with some animal science colleagues. We don't sell anything, but we put it out every week. And if that's something that you'd be interested in, you can scan this code here or send me an email and ask to be put on the newsletter list. I've been writing this newsletter now for 20 something years, Fred. I don't know. It's adding up to a lot of articles that I've written over the years. So with that, I'll stop and see if we've got some questions and discussion that we can have.
Very good. Uh, First question came in from Nathan. Do you think there's less added value in value-added marketing programs for weaned calves during calf prices like we're currently having?
I'm going to interpret that to be things like preconditioning and other things that we usually recommend that producers do. The preconditioning programs involve weaning, health management to get those calves ready to. And actually, we have pretty strong data in Oklahoma. We've had a value-added program in the state of Oklahoma for a lot of years, and we've collected a lot of data. And even though you'd think that these high prices would keep the premiums on those preconditioned calves or those value-added calves down, it actually doesn't. When you think about it from a buyer standpoint, they're spending so much money on these calves that the risk associated with health problems and death loss, obviously, is high. So what we have found through a couple of these cattle cycles now is that the premiums actually go up during high prices. And so now that's kind of a hard sell today. Calves are worth so much. We've noticed in Oklahoma the last few weeks that we're getting an early run of fall calves that would normally be weaned and sold in October, November. They're coming to town now because producers just want to take advantage of this market, and they're a little bit scared that something might happen. So we're selling these calves kind of against that advice. But if you look at the data, I would say that preconditioning still pays and would be recommended in this market.
To kind of follow up, I think, on that, we have a question that says, what is the average cost of gain for backgrounder? Is there still financial incentive for backgrounding?
Backgrounding programs are so variable that it's really difficult to sort of generalize that. I mean, we've got it. We're looking for wheat pasture here in the Southern Plains this time of the year, or planting wheat for wheat pasture during the winter. But you can do dry lot programs and so on. If you look at that value of gain chart that I had, that doesn't, that's just the gross margin, and it said that the value of gain was probably $2 a pound or less. So you've got to be able to put weight on cheaper than that, as well as pay all the other bills associated with that enterprise in order for that to make any sense. The other thing to keep in mind is when you think about the cost of gain, if you will, in a backgrounding program, it's really going to have to balance against the feedlot cost of gain. If the cost of gain at the stocker level is at or above the feedlot cost of gain, then the feedlot's going to bid those cattle away. So the bigger corn crop we have, and the cheaper that corn is, and the cost of gain in the feedlot is going to limit the potential cost of gain that would make any sense for a backgrounder. So all of those things are part of that sort of squeeze on the feasibility of these backgrounding programs right now.
Thank you, Dr. Beal. Jennifer asked, how has beef on dairy affected the fed cattle inventory?
Okay, so I showed those cattle on feed numbers and the calf crop numbers, the feeder supply numbers, all of the numbers that I included in there include the dairy, either straight dairy or the crossbred animals. The calf crop numbers that we get are for both. And this is a question I get a lot among beef audiences in particular. What are we going to do with all these calves? Well, I have to remind them that dairy cows have always had calves. They don't give much milk if they don't have calves. So we've had dairy animals in the feeder mix. They look different now because a lot of them are crossbred, and obviously that affects the value and the incentives. But it doesn't change the overall numbers all that much. So the numbers that I showed you for feedlot inventories and feeder supply and all of that does include those any dairy or dairy cross animals.
You had mentioned that there, without an external influence, your projections look like it's going to continue to increase. What kind of black swan event would you envision that could turn everything around?
Well, I think there's any number of things externally, but I mean, I don't want to get political, but all I have to say is politics. I think is there's just so much potential on all sides for things to change and to change very abruptly in terms of things that could impact us. Given that we've got so much trade related issues going on that either directly or indirectly affect beef markets and cattle markets. So you've got that. We've got the ongoing issue now with the southern border being closed because of the screwworm threat, but that's always a potential factor that could be there. So there's just any number of things that could influence the market. The most likely impact there, I will say this, is think about anything that would affect beef demand. It's more likely to come through there. The supply side's pretty fixed unless we just have a total economic meltdown. Then I don't think we're going to care about cattle markets. But be short of that, and I don't expect that. But if you think about things that would affect consumers and therefore consumer demand for beef, that would be the most likely source of a shock of some kind. So if we had macroeconomic problems that resulted in a sharp increase in unemployment or just decreases in consumer incomes, consumer demand is based on what we're willing to buy and what we have the ability to buy. And so anything that could affect particularly the ability to buy is a potential threat on the demand side. So I say that we're pretty bulletproof as an industry, but we're not bomb proof. So there is that threat out there from those external factors.
Very good. I'd like to remind people if they have questions, go ahead and put them in the chat box. We still have a good enough number that I don't want you to unmute and we could have mass confusion there. As we looked at the charts and we saw the weight of these finished cattle increasing, carcasses getting heavier, has the beef on dairy affected that significantly?
I don't think it's a huge impact. It does have some impacts, a little bit on carcass weight. Obviously, the biggest impact of the beef on dairy relative to a straight dairy is what it does to the carcass conformation. So the muscle size and shape and really the shape more than anything. That's been part of the issue with the lighter muscled dairy animals. Now we've added some beef muscling to them. And so it impacts that. It does change weights a little bit. And of course, these calves feed a little bit differently. But all of that doesn't really change the overall picture all that much, I would say. It does have some impacts in meat markets because there were places that used to actually count on getting those dairy type carcasses and cuts for certain markets. Now those many of those crossbred calves and or crossbred carcasses um, can fit into a broader range of markets than they once would have, I guess is the best way to say it. And so there again, there's more implications there. Back to the idea of the overall carcass weights. I didn't put the chart up today, but you know, cattle carcass weights have been increasing for about 70 years on a relatively low level. The average steer carcass weight has gone up for about by about 4.5 pounds a year back to the early 1960s. And that trend probably hasn't changed. I used to think we were going to max out and not get bigger, and I got tired of being wrong, so I quit saying that we're not going to get bigger. What we do with genetics on both the beef and dairy side, but on the beef side in particular, continues to amaze me. Now that said, I do think there are some limitations ultimately to how big these cattle can get. We're starting to see some health problems in terms of feedlot cattle. This congestive heart failure or late stage death loss in feedlot cattle that's in part related to the fact that the size is so big. The other thing that comes into this is a little bit on the demand side. Consumers haven't been asking for bigger steaks for about 20 years. And yet, if you make carcasses bigger, the individual muscles are bigger, you're going to make bigger steaks. So there's some implications there as well. We've done some research to show that you don't necessarily help demand if muscle size and steak size continue to get bigger, but it means in most cases it means we have to do some additional fabrication and some other things to compensate for those bigger carcasses. So those are all things that are still out there that the industry will continue to wrestle with. And the beef on dairy is a piece of that, but not really changing that overall picture all that much.
Okay, we've got a question. Where is the select lean beef going to come from? If dairy used to provide a good percentage of this, will that have to come from imports?
I mean, we have significantly reduced the amount of select graded beef in the market. I mean, it hasn't been 15 years ago, 20 years ago that we were 40 to 50% of the market was select. Now we're running about 85, 86% choice and higher, choice and prime. And the dairy animals always, and actually dairy animals have always graded very well. Even though they're lighter muscled, they actually graded a better percentage of prime than beef cattle did for a long time. And so and the fact that we've got the crossbred animals now is part of that continued increase. There is obviously a need for some select meat in the market. And we do use imports to supplement the non-fed beef, which comes from cull cow slaughter. I don't think there's a real issue with a lack of select type meat in the market. In general, I understand the question because it is a big change. But again, beef markets have sort of utilized different cuts and different sources. So we are using more imported beef now, but it's more just from a quantity standpoint of needing more pounds of that type of meat. And it's really supplementing the cow side more than it is the fed animal side.
I'm going to make you get your crystal ball out. If we remove the tariff issue, we're still pretty expensive beef in the world market. Are we going to see some significant changes because of that factor?
Uh, Well, there's a couple things embedded in that, I think, Fred. One is that beef is always the most expensive meat, and U.S. beef relative to global supplies tends to be. We call it high quality, and you got to be a little careful because quality is in the eye of the beholder. But our beef is more expensive. But I think there was lots of potential for high quality beef in global markets to some extent. And so I guess I don't see that as too much of a limitation for what it is and where it fits into a broader range of beef qualities around the world. Now, in the world with the tariffs and the disruptions that we're seeing in these trade flows, one of the things that is happening is that the rest of the world is not sitting still. So I am concerned, particularly with respect to the growth we had in China over the last 5 years or so. China had increased rapidly from being a very small piece of our exports to really almost equal to Japan and South Korea as a beef market. And the thing is now that we're not really trading with them very much. They're going to be looking for other sources of beef. There's, the rest of the world is not going to sit idly by until we sort out all of our political issues and trade policy issues. And so there will continue to be evolution in that. And one of the potential implications of that is that we simply lose some, if you want to call it market share or potential market share while the rest of the world evolves. I just saw statistics the other day that cattle feeding in Australia. Australia is not known for fed cattle production. It's mostly range beef. It's the kind of beef that we use for ground beef mostly when we import it. But they do have a feedlot industry there, and it has continued to grow. And so almost a third of their beef exports now from Australia are fed beef exports. And they're not coming to the US, not the fed beef part. They're going to other markets, and they're potentially going to markets that we could be servicing, but we're not right now because of all of these disruptions.
Well, we'll give the viewers just a minute or two to put in their last questions while this program has been recorded and will be in the I-29 Moo University webpage. Give us 2 or 3 days and we'll be able to have it up. In addition, you will receive an email from me with that link. And I also will include the link to an evaluation. As we put these programs together, we'd like to know what segment of the industry is finding it useful and get feedback on what the next program should look like. So I'd appreciate that. You taking a minute and filling that evaluation out. Have one more question come in. Is the historical cattle cycle still holding, or have things changed that it's more flat?
The cattle cycle is still a factor, definitely in the U.S. Now, you can make the argument that if you measure the cycle strictly in terms of animal inventories, because carcasses are so much bigger, we get more pounds per animal, so we don't have to adjust animal numbers as much to affect a given level of change in beef production as once. But we haven't really seen any indication that the cattle cycle is flat by any means. There's still a cycle. And of course, we've had droughts that have exaggerated it. They can actually work, depending on the timing, they can work to exaggerate it or to mute it. But the last two have been exaggerated to the downside because of drought. So cattle cycle is still there. It's been a factor of this industry, but I do think we recognize that we don't change animal numbers as much because we do get more pounds per animal. So a little change in animal or a smaller change in animal inventory affects a bigger change that the market is driving, if you will, in terms of overall beef production.
Okay, Kent sent us in the question, do you see a tax advantage entering into the decision to retain heifers? With incomes as high as it is, there may be advantages to holding back heifers rather than incurring ordinary income.
Oh boy. First answer there is that I am not a tax specialist, so I'm going to be very cautious about that. But I guess what I would say is that all of those are factors that you need to sort of work through. And that's not really an answer to your question. I don't know that I know off the top of my head. We're pretty specialized at my shop. We have a tech specialist, and so I would ask him that question if I needed to know that answer. And so I don't know it off the top of my head. But I did, again, when you look at the overall financial cost today, obviously the cost of interest rates are much higher than we've seen for a long time. And so all of those things come into it, and the tax implications will be part of that discussion as well. So definitely something that you should sort out and figure out what's going to work out the best for you.
Very good. Well, it looks like I'm not seeing any other questions come in. Dr. Peel, I'd like to thank you for sharing your expertise and giving us your insights at the industry and being willing to dig out your crystal ball on the questions. So I'd like to remind people that the Beef on Dairy Dialogue is a webinar that happens every month, and we will let you know when our next one is scheduled for the month of October. At this point, I will start letting everyone go and end this program.